goals, because I think that's kind of how most of us are wired in this room in terms of like, give me a goal and I'll find a way to get it done kind of thing. So let's talk about that a little bit in terms of goals, and then maybe Slot kind of chime in there. What was the discussion in the break in terms of?
Well, just that the question was around, do you meditate on having goals? And so the idea is that meditation is just learning to be present and still without any sort of expectation or judgment or setting goals at all. So yes, your life is going to be filled with goals, but at least if you're angry, learn to sit and be angry for a few minutes before you go into trying to visualize or get out of some sort of present moment.
Right.
Okay.
Learn to just sit with it.
And with that being said, now transferring that over to Mr. Brown's world, goals in terms of somebody wanting to save for certain things or have a certain amount of money set for retirement, all those kind of things. What do we need to focus on in order to get us to those things? We'll meditate on it later after we realize how much money we actually need.
Well, let's break some myths first.
Let's do it.
First of all, everybody right now, especially when you're investing in real estate or discounted notes, which is the new craze, or anything that's going to give you retirement income, is they start now. They might be in their 20s, 30s, even 40s, and cash flow just rules their lives. Well, this is a baseball room we're in right now.
Yeah.
And the number one sentence on any baseball field with youth is keep your eye on the ball. You hear that sentence more than anything. The ball on which you want to keep your eye in investing for retirement income is the retirement income, not income now. You're not trying to avoid income now.
Right.
But you clearly don't need it because you saved enough from the cash flow from your job and other things you're doing to invest. Income's not your current problem.
If it is your current problem, okay, let's just say, because most people are going to say that it's their current problem. So why is it not their current problem? They do have enough to actually live off of and save?
Well, if they're investing in real estate,
okay,
or they're investing anywhere, in anything, their cash flow is not their problem. They have enough extra that in their judgment for their family budget, they've decided that they have enough extra cash flow to invest.
Okay, so it's just a decision more than anything in terms of just making a decision that this is more important to me now, or this is more important as my future than whatever I want than the beats that I just bought. Is that what you're saying?
Exactly. So when you go next week and try to find that Justin Bieber ticket,
I'll let you have that one. Go ahead. I won't even go back. Go ahead.
No, but look at here's the thing. When you're investing for retirement, and I have something that I call synergistic focus, because that's an overused word, synergy. Synergy means you're either going to get something faster because you're combining various factors together, multiple factors, or you're going to get it bigger. So you're either going to get more income through synergy, or you're going to be able to retire sooner because of synergy. And if all the planets align, both will happen to you.
Okay.
So let's get into an example,
Sounds good.
A case study here. They have something in real estate called depreciation. It's a paper loss. It's no big deal. It's the disintegration of the physical property. That's not a loss you're experiencing where dollars are coming out of your Levi's.
Right. It's a rich people loophole. Stop it.
Yeah, right.
That's to your coat this.
Right. So what happens is there's a way to kind of turbocharge that called cost segregation. It's just a different flavor, more intense flavor of depreciation, where instead of maybe getting $10,000 on a $300,000 income property investment of depreciation, you'll get 20. Now, the one thing that most people don't know, and there's a lot of people that make this kind of money in San Diego, once you make $150,000 in your household, you are not allowed by the tax code to take that any extra depreciation against your ordinary job income. It just sits on the shelf and gathers dust, and people don't know that. So
and that's combined household income. Is that what you're saying?
Yeah, or it just could be you,
sure.
Single, or I have a lot of people. They make he makes 90,000, she makes 90,000, and there you go. So what happens is, we have them buy a piece of property. I'm going to make this very short. They buy a piece of property for $300,000. They get 20,000 instead of 10. The property might have 4,000 or 5,000, say 5,000 a year cash flow. That they're never barred from sheltering. So every year, if they have 20,000 in depreciation and they have 5,000 in cash flow, they have 15,000 left over that because they make too much money, they can't use. So when you use cost segregation, stick with me here.
I'm with you.
Okay.
I don't know if anybody else is. I'm with you.
I'm with you.
Swandy's meditating in the corner.
There you go. That turbocharged part of it, where it goes so it doubles, really only lasts for about 5 years.
Okay.
Instead of the normal 27.5 for residential income and 39 years for commercial.
Okay.
So what the strategy is to defeat this not being able to use depreciation because you make too much money is you pay off this $300,000 property. You might have put 25% down, and you're going to pay off that loan using the cash flow, other income streams you have from other investments, and maybe some from your family budget. And bottom line is 5 years from now, you own that property free and clear. And now you sell that property. Well, you sell that property, and there might be a capital gain, there might not be. But because you used cost segregation, every dollar that's over what we call the normal depreciation, the straight line, is taxed at 25%. So if the normal was 10 and you got 20 a year, you racked up $2,500 a year in future tax liability times 5. You owe 12.5 without a capital gain. You just owe that at sale. So let's say you have a capital gain of $10,000 and you have 12.5. You owe 22.5. Let's round it up to 25,000 because you sold that property. On the other hand, now it's the year of sale. You had 5 years of $15,000 a year, $75,000 of unused depreciation.
Okay.
The IRS can now not block you from using that against your ordinary income. You don't own the property anymore.
Interesting.
So you made $190,000 that year. Now you only made $115,000 before your accountant even starts figuring taxes.
So that's the year in which you sell that home?
Yes. So say you sold that rental in July. So that year you made 190, take the 75, now you made 115. Well, if you live in San Diego, you're in California, every dollar over about 48 is 9.3% tax rate. Then add, if you're making 190, you're clearly up in the low mid 20s marginal tax rate.
Yeah, if you can get yourself down to the 120 number.
Right.
Yeah.
Well, that 9 plus say 22, you're over 30%. That means that you saved over $20,000 in taxes. You offset that tax liability, which means the proceeds from that piece of real estate are now either close to free and clear of any tax liability because it was completely offset, or mostly offset because of the money you saved on your ordinary income tax savings versus the capital gains and recapture tax you incurred at the sale, which means you now have $350,000 of tax-free money in your bank account 5 years from now that you can do anything you want.
I mean, I want to say it makes sense, but it takes a while for it to make sense. It's all you have to repeat it a couple times for it to make sense, but I think that I get it.